Okay, good. All right, great. Well, you had given me some suggestions for future classes, and I'm going to cover some of it in our last session. And actually, Evelyn Rodriguez from Benefits is going to come and answer some of your questions about your employee benefits, because I actually was on the phone with her asking her about some stuff about me that I didn't know. So I said, hey, would you mind coming for maybe like 15 minutes and answering some questions? So on May 5th, when we have the personal financial planning session, which is the session I'm going to lead, she is also going to come and answer some of your questions. So if you have any questions, my question was, what happens to my health insurance when I retire? And she was able to answer me, and I gasped and said, okay, I'm working another couple of years, But so stuff like that. Now, we're going to talk in the last session, we are going to talk about lifestyle investing. I thought that was a really good suggestion because that's really important. In other words, how you invest based on where you are in your life cycle. I should say life cycle, not lifestyle. Asset allocation is something else. I call that the eighth wonder of the world. So we are going to cover that. I believe there was somebody that was interested in some information about making big purchases and refinancing. I don't know if we're going to get to that in this short 5-week period, okay? But I do have that on our list for future sessions. We just don't have anybody that has expertise in it. Possibly. Yeah, which gets me to our program for today, which I think you're all going to be really interested in, because a lot of the things you mentioned, FICO scores and the like, are this lady's area of expertise. Our speaker today, our main speaker, is one of my interns, Samantha Davis, and she is our resident mini financial planner. She's going to follow in my footsteps, I think. And we also have a guest speaker for you. We have Michelle Carter, who is with State Farm. And what Michelle does is Michelle is in charge of training for financial products. So she's going to talk to you about credit scores and the like. And she has a very good expertise in that. She's also one of our master's students and is very active with the school here. So we're very happy to have Michelle. So these two ladies, I think you're going to get a lot out of this. And without further ado, I'm going to turn it over to Samantha and Michelle, and we'll take it from there. Oh, and the other thing, before we get started, this is the last time that we have a class in here that starts at 5 o'clock. So if you would like the sessions to go a little longer, and you can stay, we can do that if you're interested. How many people would be interested maybe going another 30 minutes? Okay, good. Then we can fit some more stuff in. And if you have to leave, I understand. But we have no class after this, so we can go ahead and make the next sessions a little bit longer. Okay, take it away, Samantha. Yay.
Good afternoon. As she said, my name is Samantha Davis. I work here in the lab. I have a very fun job. Basically, what I do is I write a program, which is personal financial management for high school students. And then we have some more clients. I've tailored it to 7th and 8th grade students, so I just got finished on Wednesday teaching a Catholic school in Fort Lauderdale about personal financial management. You'd be so surprised how engaged they were and how much they knew. So without further ado, this is Michelle. She didn't. Okay.
Simon did the intro, so we're going to get started. If you have questions, we can take them as we go along. Feel free to ask as we go along. We don't want to get you a place where you don't know the information. I kind of already started giving you some links, so you might need to write stuff down. If possible, I might be navigating for those of you guys who need to know stuff about refinancing or things like that. You might want to sign in the computer in front of you, because I will be telling you how to get to a place that you might want to look at. All right? So without further ado, let's get started.
All right, so first of all, I'm going to ask a few questions just to have you guys engage. I'm sure you guys knew about the recession, right? The big recession. What recession, right? Okay. So a lot of economists, they blame it on the subprime market. Does anybody know what that is? Subprime market. Basically what they were doing is lending to less than credit-worthy individuals. Now, they thought this was great. It's an untapped market, But when you look at that and you think about that, if you're lending to people that have a likelihood of not paying back their debt, eventually, if everyone's not paying back their debt, there's going to be a financial crisis. And now we've seen that. We've seen the bad idea that it was to lend to less than credit-worthy individuals.
So let's talk
Your credit report includes information about your personal credit. So that's going to be identifying information, obviously your name, your address, things of that nature, credit and loans, bankruptcies, and late payments, and recent inquiries.
So these are the couple things that are there. They also include your dispute statement. So if you had something where you disputed it before, that will be there. Public records like evictions, foreclosures, those kind of things related to credit, but not your arrest history or anything like that.
That'd be interesting.
Right? But what does a credit report not include?
Common myth. I have a little pre-assessment that I give to the students, and for some reason they always write gender. Your gender is not on your credit report. Your income is not on your credit report. Things about your checking and savings account is not on your credit report. If you had a bankruptcy and it's been 10 years, your slate is clean, basically. Your ethnicity, religion, political affiliation, thank God, medical history, driving record, or your criminal record is not on your credit report. Your credit report does not include your credit score. That's also a common misconception. So you go onto these credit score websites and you're trying to get your credit report, and then you look, you're like, oh my God, where's my credit score? It is not in your credit report. Your credit score is accumulated by your credit report, what's on it, but it's not on your credit report.
So who calculates the credit score?
I was like, I don't know what happened, but I was thinking to myself, I'm like, I wonder where this came up. I mean, it makes sense. We know about bartering and trading, you know. You have a cow and I need eggs and we go and whatever, right? So I thought to myself, who thought of extending credit? When I researched, I found Fair Isaac, right? But we know about him. But where did it really start from? There is something called a cuff. And what would happen is the cashiers or the grocery store attendant would walk around with this cuff on their wrist, something like a watch, but it was really big. And they would have these little tabbies that said, such and such, John, Joe, whoever, has credit of $5 because, you know, they weren't able to pay for their grocery. And they would come back in, and then, you know, they would pay. But then, obviously, you can see where that could be a problem. Someone could lose the paper. You know, what about the other grocery store? How do they know that somebody else has a credit, you know, something on credit? So that's where they came up with the credit report. And Fair Isaac is the one that actually developed the one that is all throughout the nation. The United States.
So the credit bureau scoring, there are actually a couple. There's Equifax, Experian, and TransUnion. Those are the major bureaus. And they also have different scores. Like you can get from 300 to 850 under Equifax, 330 to 830, or 150 to 934. That's why if you've ever pulled your score from all three companies, they will be different because they use different algorithms, meaning the math of what's weighted and how it's weighted to be able to get your score. In addition, we'll talk about different ways that those scores are assessed. And they're called different things, right?
Yeah, let's think about it. I don't know if you guys ever went to the bank. They're like, well, what's your Beacon score? What? Beacon score? What about FICO score? They're all called different things, depending on the type of bureau that you're going to. Okay.
So what is it, how is it allocation, the eighth grade for Dr. Simon, how do they decide which part or what's the weight on each of the things that you're looking at? So where you start off is 35% of your credit score is how you pay your bills.
And although we're going to read the percentage for you, this is like she was saying before, it's an algorithm, so you can't actually sit down and calculate it yourself. This is just a percentage. So like she said, how you pay your bills, whether or not you're late, whether or not you're on time. 30% of your credit score allocation is the amount of money you owe. So that's basically your debt to credit ratio. You got to be very careful. It's not debt to asset because your home is an asset. Right? 15% of your credit score allocation is the length of your credit history. So if you're fairly new either to the United States or, say, for instance, you're 18 and you're just now getting a credit card, you're going to find that your credit score is going to be a lot lower even if you paid everything on time. You know, you could be the best person in the world. But because 15% of your credit score is on the length of your credit history, it's going to be a lot lower. 10% is also on the mix of your credit. What does that mean? Revolving line of credit, installment credit. It depends on what kind of lender you're getting it from. So if you have a credit card versus a car loan or a mortgage loan, they like to see that mix. And also 10% is from new credit applications or inquiries. Now, that's very important, and I'm going to have Michelle take that. Go ahead.
Well, the thing about it, the 10%, everybody's under the impression that, okay, question, when you apply for a new job and they tell you, because when you sign the application, there's a little word on there that most people might not read that says something along the lines of, we are going to check your credit. Okay? Do you think that that affects your credit? Affects your credit score? Yes, I'm getting nods, yes, and I'm hearing somebody say probably not. The answer is that
Another inquiry you can think of is the inquiry that you make for yourself. Like, I don't know if I mentioned it earlier, but you get a free annual credit report, and I'll tell you the website at the end of the presentation, but that's also extremely soft where there's no points deducted for pulling your own credit report annually.
Right? So then, what are the statistics? What is going on? And this is nationwide, because by the way, South Florida has a lower, as far as the bad credit scores, if you will, we have a higher percentage of bad credit scores. So therefore, the scoring model down here, it would be a little bit more skewed when we're looking at it. So this is generally nationwide. And if you look, the majority of the population is between 600 to 799. Only 11% of the population is 800 or higher as far as the score is concerned, which is something to look at. But let's talk about how does that score affect your delinquency?
So remember I mentioned about the recession and things of that nature. If you extended credit to individuals with 300 to 499 and they have a delinquency rate of 87%, I mean, that's self-explanatory, right? So this is why this is important. Credit lenders want to look at this because they need to know whether or not it's a good idea to take that risk and extend a loan to you, right?
And then the thing about it is a lot of times what happens is I may have applied to credit at one place before, or you have a credit card somewhere and then they change your line of credit or how much money you have available, credit you have available. That's because your credit score may have changed and you now become a different risk class. And the company has to make an assessment whether or not I can take on this new risk. If I can't take on this new risk, I'm going to lower the amount of line of credit that you have, or I'm going to adjust something with you. That's where those things are coming from, right? So as far as how does it affect your loan rates? How much more are you paying for your bad credit?
So let's look at someone that's from 720 to 850. Once you've reached that 720 cap, I mean, you're in heaven, basically. So, I mean, it's great to get to 850. Once you've reached 720, you're excellent. Let's say, for instance, on average, the mortgage rate is going to be 6.2, right? Let's take the person that's very bad, 500 to 619. They're going to add 5%. And this is an average. This is a very low average. Very conservative average. But you're going to pay 5% more of that, interest on the loan. So that's basically what they use. They use that delinquency rate, and then they're going to use the FICO score, and they're going to think about how they extend credit score.
The other things that you have to look at is people with a lower credit tend to not have credit education. So they fall more victim to predatory lending. So while there was a place where, companies were going after people with low credit scores and going into the subprime market, there were some companies within there, some is a relative number, companies in there that were basically going after people and giving them balloon loans, giving them $500,000 worth of credit where they were making $30,000 a year, all those kind of things. And what they did is they actually made it worse than 5%. Okay? So it is your job to educate yourself, and there are a lot of resources out there to get that education out there.
And that actually speaks about predatory lending. This is why this
So what is the credit rating alternative? This is actually something that's new coming out. I don't know a lot about that, so Sam has to give you all the information with that.
So, I mean, to me,
Why is it that I'll pull my score, I'll go and do the smart thing, I'll pull my credit report, I'll pull my score before I go and shop for a major thing? Because I'll go to whatever the sites that Samantha's going to give you, and I pull it. But then when I go to apply for the loan or a car loan or anything else that certain industries, my score is not the same as the score that I pulled on my report. And that's because different industries weight scores differently. Okay, the auto industry, as far as, say, for instance, car buying, refinancing, those kind of things, they weight different things heavier on your credit score. Remember how we talked about mix of credit? Okay, if you're going to buy or do an installment loan, and all you have is credit card history, you don't have any history of being able to pay something where it's a fixed amount, it's a collateral loan, or those kind of things, your score is lower. Even though you might be showing that you are 800 or anything like that, you don't have an installment loan. Because that's what they weight. They're looking to see how is your payment history on a consistent basis. Basically, how consistent are you with making payments that you have to make? Because if you don't charge on your credit card, there's no issue. And that's a flexible amount versus your car payment is a standard amount. That's something that they look at. So they weight things like that. So just because you're eligible, another thing for a car loan, doesn't mean that you're eligible for a credit card. Because then it might be to your debt to income ratio and those kind of different numbers that are in there.
I'm sorry, I'm just going to give her the mic so everyone can hear.
What if you've already paid off your car? What if you had a loan, a 5-year loan or a 10-year loan, and you just paid it off in like 3 years?
Okay, it will affect your credit in the sense of, first of all, there's different things that you're looking at with your credit. The first thing is that when we talked about how much you owe, remember that's 35%? So therefore now you don't owe as much. So that's going to bump up your credit score. You paid as agreed. Okay? So the other part with the 30%, how do you pay your bills? That is actually going to help you. Now, what happens is if you get that car repossessed and you settle for less, now that's a problem. Or if your car gets totaled and you were upside down and you can't settle the amount, upside down meaning that you owed more than the car was worth, your insurance is only going to settle based on how much the car is worth. So if your car you owed $15,000, but your car was only worth $10,000 and you don't have that $5,000 to give the bank, you basically are settling it for less than. And that $5,000 actually shows up in your credit report. So if it goes into your favor that you did what you were supposed to do, that will actually work. But if you didn't, that is going to be negatively affected. The other part that's taken into consideration is how much have you borrowed before? Did you borrow $18,000 before and are now asking me to borrow $60,000? Okay? You showed that you could handle 18, but am I going to really look at a jump from $18,000 to $60,000 worth of loan? And does that match up with how much income you make? Did your income change? How long have you been in this new job where you're making that additional income? Those things are affected as well. Right?
And another important point, sorry, just to add, absolutely. Common misconception, you put off your credit card, let's close it.
Don't do that. Because one of the major things. So the other thing is that a lot of credit card companies in the last couple of years, if you did not use your credit card because you were trying to, save money, pay off your debt and those kind of things, it wasn't active. So therefore they closed your account. Okay? I've had an American Express from 1998. I dislike them. Okay? We go through a love-hate relationship. I worked there for a long time. Now they're charging me more for things that used to be free and those kind of things. But I will never close that account. It is my oldest line of credit that I have. So therefore, I make sure that I put something on it, an automatic bill and my cable bill, to make sure that I keep that account. Because remember, length of credit history is a major part of it. All right? And you don't want them closing your account. That's why when you're shopping for a house or a mortgage, they tell you do not do anything. Like, yeah, you can pay it off because it will lower your debt to credit ratio, but don't close the account because then it'll mess with your length of credit history. Just in 5 minutes, you can change how long you've had a credit history for. Yeah, go ahead, Gail.
Okay. What if you closed the credit card like 8 years ago?
Okay.
Does that still matter if you're shopping for a mortgage now?
Well, 8 years ago, it won't be on your credit score.
After 7 years, whatever was on your credit card is credit
Oh,
score. Still.
okay.
But the thing about that is if you have that credit score, say for instance, it was your oldest one, and now all your new credit, like people, this is what happens with people in bankruptcy, okay? They have credit established, they go through bankruptcy, they close all of their accounts, and now they go on a cash basis because they're trying to learn how to do things right. You need to understand that, okay, yeah, I wiped your slate clean, but you have not built up any new credit.
Oh, I kept my Discover card. I just canceled American Express because they wanted to charge me a huge annual fee. But
That kind of thing. So the thing about it is if you have other things that have the length of history
Mhm.
available, you won't be negatively impacted.
Okay.
And it's like 7 years ago, it's not a big deal.
Okay.
As long as you have accounts that are of similar length of history.
Mhm.
Where does that affect somebody if they've only had credit for 5 years
Mhm.
and then they go and cancel the card and all their other cards are 1 year or younger?
Okay.
Now I don't have anything to show.
So anything under 7 years, you definitely don't.
Okay. I have one more question. What do you do if your credit card company insists on upping your limit every couple of years?
Actually, that works to your benefit. Just don't spend it. Because what happens is, I'm going to do a little thing.
Mhm.
I'll actually do it on the board for you. All right. Say, for instance, you have 5 credit cards. Okay? And between the 5 credit cards, you have a credit limit of $50,000. You good with that? And you all over like the 3 credit cards, you may have. I need to keep this in a ratio that I can do the math in my head. Say $10,000. Okay? Your debt to credit ratio is 20%. Okay? Because you're utilizing 20% of your available credit. Are we good with that? So what happens when you cancel one of these cards? And say each of them is $10,000. You still owe the same $10,000, okay? But now you're at available credit of $40,000. You see how that changes your ratio? Okay? So but when they up the number, okay, whether or not you do it through your credit card upping your number or you apply for additional credit because you know your credit card won't allow you to do a lower rate. It won't lower your interest rate. Or they're not giving you a balance transfer offer where you can do, more of your money is going towards the principal versus the interest. You get an additional card. Just by getting that additional card, now you're 60 over the 10. See how that can make a difference. All right? So it's not always a negative thing. But remember, this is only a portion of it. This is debt to credit. Now, if you apply for new credit, but your old credit card that's up in your limit is not applying for new credit, so you don't have the inquiry, you don't have the number of new inquiries and those kind of things that will offset the benefit of it. Okay? Does that make sense? All right, good.
Thank you.
Any other questions? No? So I need advice.
I just have a real quickie.
Yes, ma'am?
Because I'm learning all this stuff too. Thank you. I went to the site that you told me about to run my credit report because I hadn't done it in a while, and then I went and I ran my credit score. Is a credit score and a FICO score the same thing?
It depends on which company that you're using. FICO is actually Experian.
Yes.
And
We're always
then-
talking about the beacon. Every credit bureau uses a different credit score.
Gotcha.
So you might have pulled your FICO, but that's Experian. You don't have the one from Equifax. You don't have the one from TransUnion.
Gotcha.
So each company may have, because they use different algorithms. So what's an algorithm?
Right, you said that. Okay. Gotcha.
A big algebraic formula, and each company weights things differently. TransUnion tends to be the most lenient, if you will. Okay, so your score will tend to be the highest. The important thing that will be, though, is which one does the lender pull? Just because your score says something high doesn't mean that that's the one that lender is using.
So having a new card does improve your credit to debt
Yeah,
ratio.
it does, but you got to also remember, there's mix of credit, there's how many credit that you have, and you don't want to stack up on different types of credit.
Yeah, it's saying that if you open too many at the same time, that negatively impacts you because research shows
Exactly.
too many at the same time, you're a bigger risk.
But it's good if you're getting increasing income and you're not going to use that, then yeah, you can use that. That's actually going to help your score for utilization.
Do they place things that the credit companies check your score?
Well, when you apply for credit, they actually have the permission to periodically check your credit.
When they increase your
they can periodically check your credit. But does that come up as a hard inquiry to your credit? No. Okay, you'll just see it on your score, not on your score, but on the recent inquiries on your credit report. You'll see them on there, but it does not mean that it impacted your credit. Okay, are we good with that? And then right here.
Hold on one second. I'm sorry. We have to use the mic because what happens is we have the class capture. They won't be able to hear your question. Okay, so that's why we're doing it.
Okay. Question for you. When you get a store credit card, say a Macy's credit card or Kohl's credit card or whatever, you go to the store and they want to sell you their credit card. Do those people run credit history?
Yes. Everybody, if you are providing your social security number to anybody, they're checking your credit. Don't let them tell you any different. They're checking your credit. Okay? So does that count? It is a credit that you have. It is on your credit report. However, if store credit is the only thing that you have, it doesn't really help your credit score.
It's a good way to start out, though.
So,
It's a good way to start.
For those of you guys who remember that, that was my first thing that I had. So that's how I started out. And then you get more and more as you go along. With my little $300, I thought it was special. So they do run your credit.
One more question. Many of the stores will give you a little card, and all you need to give them is your name and address.
Rewards cards.
Okay.
Rewards cards.
Rewards cards.
They're rewards cards, exactly.
If you give them your social,
They're running your credit.
Okay. Good to know. Thank you.
Any more questions? I think we had one more question here.
If I pay my credit, the monthly payments diligently, let's say for a year or so, do they automatically give me a low interest rate, or do I have to ask for it, or how does it work?
They're not going to give you that. They're business people. They want to make money. They're not going to do that.
So, couple things. When you're paying those payments, because I have people that'll tell me, "Oh, I'm paying the monthly payment."
The minimum payment?
But that is exactly right. If it's the minimum payment alone, all you're doing, I'm just giving an example. Just because you're paying on time doesn't necessarily mean that it has value of paying on time. So there you are paying on time, but you're only making the minimum payment. I'll introduce you to a word that's my favorite word. It's called usury. Okay? Basically, if you ever went to like read stories like Shakespeare or anything like that, or you heard about, pound of flesh, if you will, okay, I'll charge you 30%, 40% for credit. If you look at your credit card, if you only make the minimum payment because they're charging you interest on your interest on your interest over and over again, I call that usury. So if you only make the minimum payment, you're never really paying off the balance. Okay, so that's one. How does a credit card company make money? The interest rate that they charge you. Well, it's one of the ways, but the one that's important to you is that one. If sorry, I want to sneeze. If the government has limited the way that I can charge you, okay, because with the credit card bill that passed, if the government is now making sure that I can't do certain things to your interest rate, all right, if so many people in the economy are defaulting on their credit, the people who I have at the rate that I have, I'm going to keep them there as long as possible. Okay, so you pay for a year, are they going to lower your... No. They want to make their money. The other part is...
exercise.
You may call them and you can attempt to do so and ask them to lower your rate.
Right. In my case, I have been paying more than the minimum payment, like $100 or so more than the minimum payment, but still it's...
There is no obligation to lower your, the interest rate or do anything to that effect. They only do things that will make sense to their bottom line, i.e. I'll give you a greater credit line so you can spend more. That's my interest.
It doesn't hurt to ask, though.
Right. But it's a negotiating point. You can call them. You can always ask. Does that mean you will get it? No. All right? So it's always good to ask. And guess what? In this time where everybody is looking for people who have good credit, who are paying, then you can always shop around. You may not want to close that account. You may look into balance transfer opportunities with that other card that you're going to, because maybe they may not lower your interest rate, but another card will allow you to transfer your balance, which is just move the debt from that card to another card that has more favorable terms. All right? Are we good with that?
And I'm sorry, just to add on to that, the balance transfer, and this is probably a personal thing with me. I told her, I think I was telling you earlier, credit is not supposed to just be given to you, right? You're supposed to work for it, right? So now you have credit that's extended to you, right? And you're going to take care of that. When it comes to balance transfers and it's all about discipline, you're like, oh, cool, I can do that. No interest. Well, let me go on transfer to balance transfer because that's what they're doing right now. I mean, everything is always an on-tap market, just like the subprime loan. You don't see it coming, but think about it. And I think high school students are going to fall prey to this. They're going to say to themselves, well, if I can balance transfer and not pay this interest, why don't I just keep doing that? And you have all this credit and all this.
Exactly.
All this they have to pay for. So just be careful with that.
In other words, be disciplined when you do the transfer. Make sure you're actually paying it off. And if you can't pay it off in that time, check and see if they will negotiate with you. But guess what? You are their customer. So if they don't want to work with you as their customer, you might need to look for somebody else.
Are there any things that you can request to help encourage them, or are there any suggestions you have on good ways? Like, I usually keep my credit cards paid down to zero by their due date each month. At most, I might have one that has like a balance, but usually by the end of the following month or 2 months, I've got it all paid off. Is there anything I can do to make sure that when I do get snagged with those windows of, okay, this one needs to carry over, I've got it half paid this month, the other half next month, to help minimize their interest? Is there any ways or suggestions of ways to ask to encourage them to keep the rate down? Or
Well, they can't change your rate willy-nilly anymore. Okay, so that's the first thing. If you've looked at your credit card statements since last year, February, how on the front now it tells you right up front if you continue to pay the minimum balance. Well, when that changed, a part of the thing that happened is that they can't just change your rate because you know how I said about the risk? What they were doing was repricing their risk on something that you already priced me for. You told me you could charge me 10% before. Now you were charging me 15%, 20% just because you felt like it because my credit changed. But I've been paying you correctly and on time. So they can't change you willy-nilly. But by the same token, they're not going to.
I know it's coming. Like, I know I'm going to be hitting the dentist and it's going to be $1,000. That's a lot of money to pull out in one shot.
Well, a couple of things that you can look at, and I'm not going to do a plug, so I'm going to give you a couple of companies that actually does this. I want to say it is Chase, okay, and also State Farm. They have options called fixed pay or the blueprint. And what that does is it moves the charge from the revolving, i.e. I'm charging you interest on your interest, okay, to an installment loan on your credit card, where they will fix the interest for you. And generally when you move from the revolving, that's on the credit, to the fixed, they will give you a lesser interest rate for it. So if you know it's going to take you 3 months to pay that off, or 4 months, or so on and so forth, you can move it out of the revolving and put it onto the fixed. That's the major option that you have if that you know that's coming up. The other thing is that I'm sure Dr. Simon can talk about that, savings, to be able to not have to charge those things. Yeah, but it's one of those things, unexpected items coming up. Any questions? I'm going to start. No problem.
Is it bad not to carry a balance?
That's all a matter of opinion. The thing about it is that you charge it, you pay it off. But is it pay on time, depending on your cards, because there's charge cards and there's credit cards. Okay?
I'll answer that. I mean, I would rather pay it off, but they like to see a little balance. Let's keep it below 10%. Personally, I like to pay it off. They like to see just a little bit of a balance.
Yeah.
You understand what I'm saying?
Showing that you can handle the debt. Basically, you can handle the paying on time. You can handle your payment history.
I mean, if you think about it, though, but your mortgage is also on your credit report, so you can think of that as, okay, I already have utilization taken care of, so I'll pay off my credit card. So as long as you have something that, has some kind of, okay, I didn't finish the whole thing.
All right, but if you're starting off new, because I have a couple of friends, what they do is they don't buy on credit. They go ahead and they do something really fast, or they save up and they do the cash. The problem is that she does well and she's able to pay it off, but when it gets to the point where you can't just buy a house cash unless you have that kind of money sitting down. I wish, I'm telling you. Exactly. So when she now comes to apply, even though she says, I pay off everything and whatever, she's never has been tested, if you will, to see how you'll handle your credit. All right, any other questions so far? No. Go ahead.
It's a good idea to have a credit card from a certain bank, so in case that you think of applying for a loan, for a bigger one.
Okay, so the thing with that is, it's always good to build a relationship with your bank, right? But it's also good to shop around. My thing is, why not look at a credit union? If there's something that you're affiliated with, go to a credit union. They're non-for-profit. That's the first thing. So their interest rates are going to be lower because they don't necessarily have to make a profit. Obviously, they have to pay their employees and pay for their electricity and things of that nature, but they don't have to make a profit. So try to go to a credit union first, and all you have to do is have some kind of affiliation. Like, for instance, I'm my mother's child, so I get to go to Broward Credit Union, right? That works for me. So shop around first at a credit union, get a credit card with them. And then if you want to go get a loan, you do that. And if that doesn't work for you, then you can try a bank or, any kind of lender.
The other side to that, credit unions are your friend. However, like for me, it's not as feasible for me because I've been with my bank that I've been with for so long. The length of your relationship with them also matters. How much do you, like your direct deposit that you have in there also matters. As far as, say for instance, when Chase bought WAMU, I was not happy. I'm really not happy about that because now I have to pay for checks. However, I've had them since 1998. I can't go now and cancel them because I have a really nice line of credit with them that they will clear anything. I can get a loan with them very easily. I don't have to reestablish a relationship with a new bank. So it is all about the relationship and how much money you have coming in there on a regular basis.
I have one more question. What is your suggestion? How long you should build up this relationship in case that you have your check going to this bank? How long do this?
It differs between different institutions. Okay, so you can go to the credit union and you have the direct deposit and they see that you're there, and then you can get a credit card with them and they see the multiple lines of relationship also matters as well. So if you have both a checking and a savings and a credit card with them, you are looked at a little bit better than, say, for instance, just somebody who has insurance with me. It does make a difference.
And what's a good idea, and I'm talking from being in the banking industry, get to know your teller, get to know your bank manager. I remember one time I pulled up and I had a check that I was cashing for whatever amount of money, and I was driving to the drive-thru. Now, they thought this was out of the norm. The branch manager knew me, so he came out. This lady didn't know me. She went and she got the branch manager. She's fairly new. And she called the branch manager, and he was supposed to be signing off on it. He looks at it. He knows the name. He's like, oh, I know her. And he looks at me in the face. What that does deters identity theft and things of that nature, but also it builds a rapport. Not only does the bank know you as just a number, the actual branch manager that can make some kind of decision knows you as well. So it's a good idea to get to know your teller, your branch managers, your I think they're called FS and things like that.
Yeah, the financial services person that's there. So that's a big deal as well.
Does it matter if your credit union is a part of the credit union swirl, and if you had an account at another credit union that was part of the swirl? Does it help you or hurt you in any way?
What it does, it depends. It depends on how the merger went. You're saying like they merged?
No, there's something called the credit union swirl where you can operate accounts. Okay, let me give you an example. I was in Arizona, and I had an account at a credit union in Arizona. Now, I can operate my bank account from Arizona through a bank here because they're all part of something called the credit union swirl.
It's like a sister.
Yes.
It's like a sister bank.
Right.
Of course that helps you because what it is your sister. So they look at you like, okay, well, you have preference over me that's coming in you.
Okay.
You know what I'm saying? So yes, and like I said, just get to know them.
So the fact that I've had the bank account at this bank for 5 years, but at the other bank for 10 years or 12 years is going to help me, right?
It depends, but it depends on the institution. One bank may look at it as like, okay, well, you've been with us for 5
Right.
years. It matters if they get that information sent to them.
Okay.
Some of them are actually separate systems.
Okay. Okay. Thank you.
Any other questions right now? Because we got to talk about as far as we talked about the auto industry part. Okay. This is the factors that we've kind of touched on already. If you settle for less than owed, if there was a repossession, previous 2 years, that is weighted more than on an auto loan on what you've done versus, say, for instance, a mortgage is looking at your last 7 years and those kind of things. So be good. So depending on where we are with the scores, what they look at. And by the way, these numbers are individual to banks because some banks will take on risks that other banks will not. So some banks will say, if you're not earning at least a 720 score, I am not going to approve you, while somebody else will do a 600. So just because the dealership approved you for a loan doesn't mean that everybody's going to approve you for a loan. Okay, so when you're looking at those refinances and those kind of things to look at. All right, wait, so let's talk about the refinances here. Yes? Okay, so as far as the refinancing is concerned, there's a thing you can actually, anything that we're talking about here, the majority of it is on myfico.com. If you wanted to look at that, it's MYFI, as in Fear Isaac, CO, company.com. If you go to that site, in the middle, on the tabs across the top, it says Education. You click on that tab, it has a lot of information there. Okay? So myfico.com, Education tab, and then if you look down, you'll see a pink piggy bank. You click below that, it says Enquiries. Okay? What is an inquiry? Those kind of things. You would like to look at that. For those people who are looking at shopping for a car, shopping for a loan, shopping for anything like that, because you don't want to go to a shady dealership that will tell you, oh, well, I ran your credit score already. So I don't know, you're going to go shop down the road when I've already looked at it for you. You know, that's going to affect your credit. No, it doesn't. If I am applying for the same loan, okay, I'm going to look at different companies because I'm shopping around. Why should I be penalized for that? So what the scoring model does is that they'll look at it and take out, if you shop between 14, some 30 days, some even show 45 days. I would say the sweet spot is between 14 to 30 days. Okay? What does that mean? March 1st, I apply for credit at Esserman Nissan. Okay? I need to make sure that my credit shopping, whether or not I'm going to Honda, Toyota, this, that, or wherever, that I'm done doing that before the end of the month with all those companies. The other thing is that a credit inquiry does not affect everybody's credit score the same. The higher your credit score, the less of an impact that a credit inquiry will have. And that's actually right there on the same screen that we were looking at as well, that I just told you about. So for somebody who has a 600, inquiry might affect your credit 15 points. But somebody else, it might only affect it 5. The other thing is for a refinance, because you are not adding additional debt, you're refinancing the debt that you already have. Within 60 days, it will come back up. All right, as long as you make those payments on time. Are we good with that? All right.
Next. All right. Oh, all this information is going to be on the website that Dr. Simon provided for you. So if you don't get to go through all of it, you can always access it on the website. Insurance, credit score.
All right, this is my sweet spot. Do you know, some people, they're like, okay, well, you know, I don't have a credit card. I'm not going to do anything with credit right now, so on and so forth. Do you need auto insurance to be able to drive a car in the state of Florida? Okay, do you know that your credit score affects your insurance rate? Okay, if you didn't know that, it does. All right, what does a score do? Most companies here, there's a thing called an actuary, and what the actuary does is they look over the risk and they look at how to price their product based on the amount of exposure that they have. Saying that if I insure Toyota Corollas, okay, in South Florida, they have an X amount of percentage of being totaled, okay? So that will rate the Toyota, okay, based on how much I should price the cost for the Toyota. And how much will it cost me if it's got completely totaled versus a minor repair, which is why a Porsche's insurance would be more expensive than a Toyota Corolla. It kind of makes sense, right? So now let's think about it. If I have somebody who statistics have shown that if your lower your credit score is, the more likely you are to file a claim. Wouldn't I price for that as well? Because if you file a claim, that's an exposure to me, right? So I'm going to price for that as well, okay? So how does that pricing work? I might say, if you're within this score or so on and so forth, I'm going to look at charging you more based on that. But you can't just say it's credit score only. You actually have to look at what your experience is and what your loss ratio, your actual company's loss ratio. So some companies that cater to lower income, new immigrants and those kind of things have a higher loss ratio based on lower credit scores. So therefore your credit will affect your insurance rate with them more than another company that does not look at it as significantly. All right? They have to let you know that they're running your credit. And you see all of these companies online saying you don't have to give your social or those kind of things. Yeah, you don't have to give your social, but it's only a basic picture. It's not the credit score for you. And if you're going to buy my insurance and your credit score is not good, it is going to up your price. Okay? So that's another thing that you might want to look at. All right? Any questions about that? Nope? All right. So, yeah, that's good. So it's unique to each insurance company. It's unique to the line of business as well. So your auto impact is not the same as your homeowner's impact. The other thing is, how many of you guys know that there's different subsidiaries to each insurance company? Like, say, for instance, Allstate will have Allstate Floridian. They'll have Allstate another name. They'll have different names for the same company. And in actuality, what they're not telling you is based on your risk, your motor vehicle report, your age, your car, your credit determines which company you go into. And then they'll know which one is their higher rated company and their lower rated company. So if you have the good credit, the lesser credit claims and those kind of things, you go in the top line credit. If you're in here, we've had a lesser loss ratio. So your price is actually cheaper in the same company because you're in different subsidiaries of the same company. So there's something to look at. So you'll notice like you'll get your bill and all of a sudden you are one name on the bill and then you'll switch over another name. That's why that's happening. So just so you know. But the thing is, unless you're within the company, you don't really know which one is this one or this one or this one or that one. So it doesn't make a difference, no. But you should shop around. That's all. Okay? Here's some helpful information. We kind of touched on a lot of this already.
Yes, and it's actually all on the website.
Okay?
All this information is helpful.
Yeah, so we're good. Shopping around for lenders, closing unused accounts. We kind of have touched on most of those things already. Yes?
One thing I wanted to touch on, I know she was talking about some credit lenders, they'll extend credit, give them 720, and other lenders will extend 600. Be careful of those lenders. Are they, it's the same thing like the subprime market. So things like that, even though it's like, oh my God, they'll give me credit. Why?
They're pricing you for the risk. Don't. What's that? The Trojan horse? And there's companies have to prove their credit worthiness and those kind of things. So if they're not pricing it for the amount of risk, just like when we talk about investments, your return has to match the amount of risk that you are taking on. So if the insurance companies or the bank or whomever is taking on a higher amount of risk, based on the same default ratios that we're looking at, I'm going to charge you more, all right? Because I have to price myself for how much of you guys are going to default, okay? How much is it going to cost me for those default? Because repossessions aren't cheap, okay, to go through that whole process of being able to do that. It also affects if you've ever had to buy insurance. How will they extend that credit to you? Because insurance is prepaid. If I have insurance, I'm not paying it 30 days. I need insurance to pay for today for the next 30 days worth of coverage that's being extended to me. So am I asking you for 6 months up front? Meaning I'm not extending you credit. All right? And that may be dependent on your credit score. All right? Are we good with that? All right?
I just want to run through this really quick. I'm pretty sure keep going. I'll tell you later. There's some stuff on here that I'm sure you guys may have already known, but it's things that when I remember when I used to work at the bank, a lot of the customers would come in, what is this? All right? So availability of funds disclosure, that's important because sometimes you'll go in and you're thinking, oh, because I go to Chase, I get my money automatically, that this bank, whatever bank it is going to extend it automatically. That's not true. They give you availability of disclosure form, you need to pay attention to that because you're thinking that money is available to you, you go charge your card, it's not there.
Yeah.
Right? So that's why that's important.
Wait, one thing I want to say about that, and especially for you guys who have changed how your debit card works, because a lot of people, they were like, oh, I'm going to take off that thing where you guys are charging me $39 for if I swipe and I don't have any money. Well, if I swipe and I don't have any money, decline it. All right? Because I don't want you to do the overdraft protection. What people don't understand is if I put in a check and you don't have overdraft protection and it's returned for insufficient funds and you don't clear that check, then it's going to be on check fax. Okay? Or check systems.
It's a system between the bank, just like we have a credit report. The bank have basically the credit report is only for the bank. And all the bank history, so if you've had, like, for instance, you owe or you're in recovery from another bank, it's going to be on check system. And that's how that works.
And they may not open that account for you because you have something out there. So just something to think about.
All right, extended hold. If you have a larger deposit than usual, they'll extend the hold. There's cutover and turnover. That's important. I have a lot of people that rush in. Did I make it before 2? Well, some banks have extended it to 4.
And that's one of the things that affects how long you've been with a bank. I've been in the bank so long, if I come in with a check up to a certain amount, even if it's an outside check, they'll have the money available to me the same day. Versus when you go to a new bank, they might have a 3-day hold on that same money. 7-day hold, depending on what you're looking at. So just be careful with that, and that goes with the available funds versus posted balance.
We all know about maintenance fees, depending on the type of account that you have. You have a minimum balance accounts. See if I can tax that. Interest-bearing accounts.
And watch the interest-bearing, because you think you're in an interest-bearing, but there are breakpoints. You only get interest after you have X amount of dollars, and it has to be your average daily balance. You can't have the X amount of dollars for one day and then spend and think that you're going to get that interest.
It depends on the bank. Does the bank compound daily? Does the bank compound infinitely? Does the bank compound monthly, yearly? You want to go to whoever you're opening an account with, your banker, you ask them those questions. It should be able to answer it.
Yeah. If they don't, find somebody else.
Non-sufficient funds, overdraft fees. I'm sure you guys already know that, but unavailable overdraft fees, that's important. Remember I was telling you about the museum cutoff, right? So you go in and they go ahead and they say, okay, I'm going to pay for that because you have that overdraft limit, right? They charge you $39 regardless. Why? Because it wasn't actually available. Even though it's on your posted balance, it's unavailable. So those are things to look out for. Return item fees. Oh, that one's big. Let's see what else is good. Charges, posted debits.
International charges, we want to talk about?
International charges. Look, I'm such a bad banker. So I'm in Jamaica, right? I'm on vacation.
You didn't call them, did you? Uh-oh. Here we go.
That's the first thing. Whenever you're leaving the country, you let your bank know. Some banks don't require this, but it's very good because if they see that you keep doing that and then there's something negative on your account and you've done for taxes and things of that nature, then they'll take it. Maybe this is not true. You understand what I'm saying? That's the first thing you want to do. But also, I purchased a book here in the United States, but I think it was coming from China, right? They charged me international charges. Now, this is all relatively new to me because the bank that I worked for before did not charge for those things. That's another thing to pay attention to. And some of the fees you're looking at, and the banker themselves cannot explain it. Find someone who can.
The other thing is if you use your credit card outside of the country, they charge you based on the settlement date. The exchange rate is a different rate than what you thought it was because it depends on when it was settled. And some of your credit cards, American Express, will actually deny your charges if you do not call them before because they have account fraud monitoring. They didn't expect you to go out of the country. You didn't call me and tell me. Yeah, I will hold your charges. So you call your bank and they will ask you how much do you expect to spend or how much are you thinking that you're going to spend. So that's something to look at. Oh, good. One last question.
So if you're going out of the country, do you suggest to take cash?
No, because then
Use your credit cards?
Call them. Call them and let them know you're leaving. Yeah, so that you don't have that issue. All right, so we're going to wrap it up. Yes, so we're done. Yes?
Yeah, we have to be done because we have another group coming